So as my business gets bigger and bigger every single year, the thing that I want to learn and understand the most is accounting, because all great businesses know all their numbers inside out. If you don't have solid accounting knowledge, you're really going to struggle to compete against all these other companies. What I learned is that great CEOs are 50% numbers, accounting, and 50% business and strategy. You have to have a bit of both if you really want to be a great CEO. And one of the most important topics that we learn about is franking credits. This is something I struggle to understand. I have no idea what it meant. And that's why I spent the day studying, researching, and understanding. And I've basically broken it down in the most simplest scenario for you and basically explained it in the most simplest way. So let's go into today's video. Franking credits. So what is franking credits? Basically, these are dividends that you receive from your company, from stocks that you sort of purchase, described as being franked. Because let's say when you invest in Coca-Cola and they give you a dividend, that dividend is money that has already been paid tax on. So it wouldn't make sense for you to pay tax on this income again. You'll be ended up getting double tax. So franked dividends have a franking credit attached to them, which represents the amount of tax the company has already paid on that dividend that you've received. Franking credits are also known as imputation credits. So the key takeaways are that franking credits are to prevent the government from double taxing you. If the tax is already taken when the money was given to you, there's no point for them to tax you again, because then you'll get double taxed. Basically, see franking credits as a tax credit. So let's sort of do a case study. James owns shares in a company. The company pays him a fully franked dividend of $700. His dividend statement says there's a franking credit of $300. This represents the tax that the company has already paid. The company has earned $1,000 and they paid $300 in tax, and the remaining $700, they gave it to James. This tax, so the $300 represents the tax the company has already paid. This means the dividend before company tax was deducted would have been $1,000. 700 plus the $300 in franking credits, or $300 in tax paid. So come tax time, James must declare $1,000, the $700 dividend plus the $300 franking credits in his taxable income. If his marginal rate was 15%, he would have paid $150 tax on the dividend. Because the company has already paid $300 in tax, James will receive a refund of $150. So instead of just receiving $700, he will receive $700 plus $150. If tax was a higher tax bracket, he may have not been entitled to a refund of any of the franking credits, and he may have had to pay additional tax on top of the $700. However, if he is a low income earner, it's possible to be refunded the full amount of franking credits. So here's another visual representation. Let's say you receive a dividend income of $100. That means $70 is cash and $30 in franking credits. If the tax rate is 10%, 10 times $100 of dividend income means you pay $10 in tax, but you have a $30 franking credit, therefore you'll earn $20. So when you get $100, instead of only receiving $70, you'll receive $70 plus $20. So the first option, you'll receive $90. The second option, you'll receive $70. And the third option, you'll receive 70 minus 20, which is 50. So let's go with the second option. Let's say your tax rate is 30%. So you pay 30% on the $100 of dividend income. So your income tax is $30, but you have franking credits of $30. Therefore, it's zero. Tax rate of 50%, dividend income is $100. Therefore, you pay a tax of $50, but you have a franking credit of $30, so you minus 20. So you pay $20, so you lose $20, and you will end up with 70 minus 20, which is 50. This is a bit confusing. Let's see what's a better way to explain this. Because I know it says the net effect equals zero, for example, the middle one, but you don't keep $100. You actually only keep 70. Let's go over another example. So here's a tax bracket that I'm going to go with. Let's say Study.com company earns $100,000 and pays, and I'll show the tax bracket for the company is 27.5% in tax, so $27,500. So the company has $72,500 in cash plus $27,500 in franking credit. Now let's say Study.com distributes a fully franked dividend of $10,000 to Annie Mine, who currently earns $0 and has a marginal tax rate of 0%. his dividend statement says there's a franking credit of 2,750. So basically together it will be 12,750. But you know, the 2,750, that's the franking credit. Andy would be receiving 10,000 plus 2,750. And since his tax bracket is at $0 because he doesn't earn any money, he'll receive the whole 12,750. Therefore, earning back the 2,750 that was paid in tax for that $10,000. So I don't know how to easily explain that, but let's say the company earned 12,550. The company would have paid 2,750% $50 in tax because that is 27.5%. But since it was shared as a dividend and given to Andy Mai, he could claim back that franking credit because Andy Mai earns 0% in tax and get the whole 12,750. Basically, it's saying, hey, the company paid 27.5%. But you've given all the money to this person who earns zero. Andy Mai earns $0, and since Andy Mai earns $0, he should not be paying tax. Therefore, he gets to claim the tax back. See, money's not being gained or earned here. The company, if we did this the other way around, where the company earned only 12,750, paid Andy Mai as an employee and given him a wage, the company would earn now $0 and pay zero tax. Andy, who is underneath the threshold, would also pay zero tax. So therefore, everyone pays zero tax. But this is a way where you spend this much in franking credits and you get it back. So it balances things out. Money doesn't magically appear. Example 2. Let's say Studying.com earns $100,000 and pays 27.5% in tax. So the same thing, but this time, Andy already earns $37,000. And every amount above it will have a tax rate of 32.5. So I know this graph is a newer graph where it says anything above 45,000, but last year was $37,000. That extra $1,000 that was given to Andy Mai from Studying.com, that has already paid a tax bracket of 27.5%. But when Andy Mai takes on that extra income, he'll be paying 32.5%. So Andy has to pay the difference of the 5% in tax. See, rather than Andy Mai paying 32.5% again, on top of that 10,000, which has already paid 27.5% in tax, he'll only have to pay the extra difference, which is 5%. So if you sort of do the maths, rather than paying another 32.5% on the 10,000 received, Andy only has to pay $1,393.75. So therefore, this 13.95%, it should be around 5%, but I don't know, the maths might be off a bit, but you're sort of getting the general idea. Rather than paying the 32.5% on this $10,000 that was received, since the $10,000 was already paid tax on by the company, Andy Mai only has to pay the difference. And that is how franking credit works, where you can go ahead and sort of claim the difference back through distributing it to different people and different shareholders and different owners of the companies, or just distribute profits. Once you really understand this, there's pretty cool things you can do within the company, within the shareholders, and within you as a director. So I know this video is quite confusing. I'm still trying to wrap my head around it, but hopefully I was able to somehow give you guys a gist of what franking credits is and how you can use it to your advantage. So hopefully you guys enjoyed this video. If you guys did, please drop a like below. Let's go ahead and announce last video's winners for $1,000 worth of courses in consulting course with me. The winners here. If you guys want to call, all you can do is drop a comment below, follow me on Instagram, hit the subscribe button, hit the notification bell, like this video, and I'll be picking the best comment every single video. On that, I hope you guys have an amazing day, and I'll see you guys tomorrow with more value. Peace.